Just a few hours ago, SoFi CEO Anthony Noto participated in a Goldman Sachs conference where he shared details about a brand new secret product the business has been internally testing. He also talked about how financial services is going to maintain their over 80% growth rate. He talked about the pipeline of technology accounts. He talked about lending as a service. This was an over 40-minute talk, which I've condensed down to the most important segments. I've broken them all out into clips. I've timestamped them and captioned them. And I'm also going to provide some commentary and some of my thoughts around this. Let's jump right into it. So Anthony Noto started off by talking about the vision and mission to help members achieve financial independence. He did mention that the business had 10x their revenue in 7 years, going from 250 million to 2.5 billion. Today, they have about 8 to 9 different products where they collect a ton of data on how you spend. And as we know, they aim to be unit economic positive with each of their products. They talked about the lending product being very profitable and how that also will benefit from a lower rate environment. They talked about the invest segment more in depth and how they're just getting started on the credit card platform. And then he went into this segment where he talked about an exciting thing about SoFi's future. And he said this term products on top of products, which I took to mean this ecosystem benefit where you essentially have an aggregate benefit or a network effect from all of these products being built on top of each other, and you can essentially cross buy into these products. And he illustrated this example with two new products that they were testing internally. The first one is Cash Coach, and the second one is SoFi Plus. And he talks a little bit about the details of both of these.
I think the thing that's probably the least appreciated about where we're going from here, beyond just building trust and awareness and continuing to drive penetration, market share growth, and making the products work better together, is creating products on top of the products. So, for example, we're testing something internally with our employees called Cash Coach. Kind of a whimsical name, but it's pretty cool. So in my app right now, I can click on Cash Coach each morning. It looks at all the cash I have across all of my SoFi products. And if I have other products connected via Relay, it looks at the cash there as well and actually gives me suggestions on how I could better optimize my cash. As an example, this morning, I clicked on it and it said, you have excess cash and you have $1,659 of outstanding balance on your credit card. You should pay it off now because it's a better return than actually not. So I clicked on that button and I paid off my credit card debt this morning. If you had $10,000 sitting in a checking account getting 0.5% interest, it would explain to you that our savings accounts at 4.5% interest. You could also invest in diversified way through ETFs or through robo accounts. And so that's a product on top of products. We couldn't create that product without having everything else, Relay and checking and savings, credit card, et cetera. Another product that we'll be testing at the end of this year and roll out in 2025 is SoFi Plus, a subscription product that allows you to get high interest, high rewards, discounts on other products, dedicated certified financial planner, access to things like IPOs, alternative investments, and other things. That product will be priced at a level that is paid for by the benefits you get in well excess of that price. But it also allows us to market to members and say, if you sign up for SoFi Plus, you get exactly what there is. There's no asterisks, there's no requirements. It's all part of the subscription product in much of the same way that Amazon did with Prime. When Amazon launched Prime and getting free shipping, you never had to factor into the price you saw on the screen another price. The price you saw on the screen was the price you paid. And so we want to have a product that you use and you get more value from using it, but it also telegraphically says you get whatever it says. There's not a bunch of asterisks because you're automatically a SoFi Plus member. This is a technology-driven product that you could only do if you're a digital company and you had all the products and services that we have. Unique value that's extracted from the data and giving back to the members based on everyone's activity.
I'm expecting for both of these, we're going to have more information towards the end of the year after they're done internally testing. They also talked a little bit about the member acquisition strategy, saying that, yeah, each product has a customer acquisition cost, and a lot of their marketing, about 25% of their marketing budget, is on branded advertising. So this is more around the mission and the vision, or not around specific products. So they're not really talking about, hey, here's SoFi credit cards, here's SoFi, money. They're talking about here's what SoFi is trying to do, here's what we stand for as a brand in order to get that unaided brand awareness up. He mentioned that unaided brand awareness is up 40% year over year, and it's over 4x since 2018.
One of our critical success factors is we need to become a household brand name. People need to trust us, and we spend a lot on marketing to do that, and it's multifaceted. Each business has to deliver a customer acquisition cost that's supported by their unit economics. Some of the businesses derive a return on that investment within 12 months. Some, the payback period is not for 24 months. But each business has its own identified customer acquisition cost. In addition to that spending, we also spend about 25% of our marketing on branded advertising. Typically, that branding advertising actually had been dedicated to specific products, but more and more you'll see that branded advertising being spent across the entire umbrella. As an example, we released this weekend a new campaign with Justin Herbert. Phenomenal campaign, but it's holistically about getting your money right, not just an individual product. I believe we just scratched the surface in how many members and products we acquire in a quarter. We find the more we spend, the more we grow, and it's at an acceptable return. So right now we're just balancing growing versus profitability and ensuring we have that right balance. I do think over time you'll continue to see us benefit from word of mouth. Our unaided brand awareness has increased 4x since I got to the company. It was up 40% versus a year ago. As your unaided brand awareness grows, your marketing efficiency also improves. So it's a double bottom line.
They then talked quite a bit about financial services and the growth drivers of financial services. And Anthony Noto mentioned that being profitable despite losing $100 million in credit cards investment is a big win. And one of the things that they touched on here, which I think might have been missed, is that they're severely under-monetized and invest by 50%. There's a lot of upside in revenue growth here. He touched here on credit cards, saying that it's an initial product. They're learning a lot about it from their internal testing of the 2 new credit card products that they announced in July. And the goal is to bring credit cards to the 8.8 million members. So, and I've talked about this in previous videos as well, how that 8.8 million member pool is a perfect ground for them to cross-sell their credit card products onto.
The best way to think about modeling or growing that segment is product growth and revenue per product. So within Invest, we're under monetized by about 50% compared to where we would be if we had a complete suite of products that generate revenue there. So there's a lot of upside in continued product growth, but also a lot of upside in revenue per product, and you have the dual drivers of growth. And now that we're profitable, we can increase that investment there pretty meaningfully. Within Invest, we've really differentiated the product we launched with fractional shares. We pioneered that. We have a handful of our own SoFi robo accounts, some of which have won awards for the performances over the years. We have our own ETFs that are now starting to become sizable. We'll do some iteration on both of those products to generate better monetization. They've been largely free. We recently launched alternative assets, which has been a great contributor to our asset growth there. We talked about our net flows growing pretty meaningfully in Invest in Q2. We've seen that continue into Q3. Alternative assets and mutual funds have helped increase the awareness of that. So we really like the trend there. And of course, we have IPOs, which we started offering 2 years ago and we'll continue to offer. And as the IPO market opens back up, we hope to have some very unique offerings for our members. It builds awareness of the product, but it also gives our members access to IPOs at IPO prices, which is very differentiated. Within credit card, we launched an initial product. We learned a ton about it. We just recently launched 2 new products there. We're really focused on our 8.8 million members and bringing the credit cards to them, when that could be a really sizable business in and of itself. And so not only is there great opportunities for growth in financial services, it's a lot more economical. 75% of the members we acquire and Invest now come from an existing area of SoFi already, and that used to be at 35%. So we really have a lot of productivity-driven cross-buy. Invest is now to the point where we're getting a return after about 18 to 24 months, and that's with monetization at half the level. In credit card, we've seen a good improvement. We talked about on the call the improvement we saw in entry rates and losses there, and that's continued to improve as well. So in addition to customer acquisition costs for credit card, we are still fine-tuning the credit model and making sure we get to a point where that business can generate a variable profit prior to the fixed cost, and then you have enough scale times the variable profit to cover your fixed cost. Same pattern we had in SoFi. So they're on track, and we're very encouraged by where we are.
They then moved on to lending, where Anthony Noto explained the math behind the underwriting model, saying that they have 8 tiers to essentially stress test their underwriting models, and they navigate between those 8 different tiers, and they're seeing demand for the loan buying increase.
We're pretty disciplined. We have about 8 different tiers. Depending on where the economic indicators are in our dashboard, we can track those tiers. So at one point, we were down to just underwriting 1 through 4 tiers. As the economic indicators change, it allows us to move up or down within those 8 tiers. We're managing to a life of loan loss of 7 to 8%. And when we stress those scenarios, we have to get back to that level. Some of that's internally driven. Some of that's more driven by regulatory rules as well. So the team team's done a great job of navigating within those tiers to make sure we've had disciplined credit. As we mentioned in Q1, we saw a peak in delinquencies, and we're both on a dollar basis and a percentage basis, and we're encouraged to see that. We shared some cohort analysis of life of loan losses compared to 2017, and those curves are also a great leading indicator of how the actual loan portfolios are performing by vintage as opposed to just the future performance. So it's a combination of those things that have driven our credit decisions. There are some credit products that we would underwrite with a significantly more volume if the demand was there. So student loan refinancing, great product. It's a small component of our balance sheet today. That's a great driver of the type of customer we want. So as rates come down, we expect that to pick up pretty meaningfully. Agency home loans, we'd underwrite as much demand as we could have because it's capital light. We do have the capability now of doing home equity loans as a principal, in addition to refinanced home loans, that would benefit meaningfully from a lower rate environment. On the personal loans, our balance sheet's pretty large. We've managed that business this year relative to the credit outlook and being conservative. But with rates coming down, that business would benefit as well. We'd likely want to sell more there to increase our originations if we chose to do so. But we're seeing the demand for loan buying increase quite meaningfully also right now.
And they touched on a really interesting piece here, which is lending as a service, where essentially they're getting paid every quarter in the form of fees for origination, marketing, and distribution capabilities. So I'll let the clip play here and you can hear more about it.
We have been doing lending as a service or loan platform business that originally started by taking our declines and sending them to a marketplace that involved into partnering with people using their credit box. And now we're in the next evolution of the loan platform business where we're actually underwriting loans for partners in our credit box for volume that we wouldn't otherwise want to write, just given the size of our balance sheet where it's at today. So you'll see more and more of that business go towards fees. We have about $90 million of fees a quarter now from introducing that product. And as we start to leverage the loan platform business, we'll just be paid for the capability, the origination capability, marketing capability, distribution, and servicing, and get paid a fee for that as well.
He talked about the 50 basis point cut, how that would spur a lot of decision making for 2025, as a lot of these businesses would use it as an indicator on how aggressive they should be with their spend in 2025, and how that was then going to translate to technology platform as well as SoFi's B2C segments as well.
As rates come down, the demand for refinancing will happen, and there's a couple of reasons for it. Just simple math. If you have a loan that's at 8%, you can refinance at 6%, you're leaving 200 basis points against $70,000 on the table. Now, you may be motivated to do that in the intermediate term because you think you may get forgiveness. But as rates come down and there's no forgiveness, people are going to look to refinance. There's no prepayment cost. So if you think rates are going to keep going down, there's no risk in refinancing now because you do it again later. The risk is if there's forgiveness. And so as the credit bureau reporting comes back, which happens here in the short term, as programs like SAVE from the president that he thought he would have a potential second round get shot down by the Supreme Court, the demand's there. So last quarter was our largest quarter in 3 years in the second quarter because people are coming back to that market. And many of the student loans that were issued in the last 3 years are at a pretty high rate. It's a combination of debt being at a higher rate, less opportunity for forgiveness, and rates are starting to come down to cause people to be interested. So we think we'll have a lot of demand as rates come down. In addition to that, we do home loans now, and we have the ability to balance sheet those loans or to sell them as well. So we're geared up and ready to go. The day that the yen carry trade disruption happened and rates dropped, we saw the number of lock loans that day double. Now, they came right back down the next day, but it shows you the sensitivity that's there just on a 25 basis point move. So we've geared up. We've worked hard to be in this position, started adding new MLO capacity. So when it comes, we're going to capture it.
Finally, the last little segment of the talk focused on the technology platform, whereby Anthony Noto highlighted the thought process behind large organizations making decisions for 2025 and the pipeline of deals.
I would think about our technology platform business today as three sort of distinct products. One product is card issuing and processing, and that was the first original business. The second business is all of the capabilities that we build via APIs. So all of the microservices you need to be a depository institution, to be a checking product, to do B2B payments. And so we've built APIs for account opening, for balance checks, for P2P payments, for two-day early paycheck, for secure cards. So there's a whole farm of APIs that we've built so you can just build your application on top and use all of our APIs. And then the third business is the core banking business. Think of that as an operating system for banking. And a lot of people don't understand that there's a different core product for every product that's out there. And so many banks and institutions have cobbled together a bunch of different cores for a bunch of different products. What we have in our Technisys core, we call it Cyberbank core, is an extensible core to any product. And today, that's a product that we offer in checking and savings, in loans. SoFi uses it for buy now, pay later. We'll soon use it by the end of the year for commercial payments, and by the end of next year for our overall SoFi Money product. So those are three different areas. As rates have gone higher, as the economy's come a little bit uncertain, people have delayed decisions. People have also delayed launches. And so we were impacted by two things. Some deals we've won where companies, because of the economic environment, the uncertainty, decided to push off when they're launching, and that's had an impact. And then some companies that are very large, big partners have pushed off making decisions until they have better clarity on interest rates and the economy. The most common phrase I hear from my team is, where are we in X RFP? Where are an X business being awarded? They're waiting to find out about their 2025 budget. So rates going down will impact not just direct products, but also indirectly corporations. And I was on CNBC last week and someone said, well, what's your view on rate cuts? And, I made the point that if you're going to cut 75 basis points between now and year end, you're much better off cutting 50 basis points now, because you'll spur more economic activity next year, because corporations are making decisions about next year now. And if they know they have 50 basis points on a huge balance sheet of debt, they could do more hiring, they could do more investing, even having that information. So we'll see how it unfolds, but I love where we're positioned, and we haven't lost any of the large deals that are out there. We're in pretty good stead for those deals, and I only see the demand for what we do increasing. It came out today that the FDIC is going to crack down on sponsor banks and banking as a service and require sponsor banks to have ledgers for their partners. Guess what? Cyberbank Core is a perfect product for that type of capability, especially if the regulatory rules on reporting and information continue to change. You're going to want a dynamic ledger that you could add other products to and in real time, in a moment's notice, and have real-time reporting. The biggest need right now for upgrades of core technology, because of end-of-life technologies that exist already, is from the largest banks in the country, in the United States.
Finally, Anthony Noto ended off talking about his excitement for 2025 in the rate environment, but also how all the segments are firing on all cylinders and how that's going to positively project the business moving forward. Overall, I thought this was one of the most insightful talks and the interesting observations across.
I'm super excited for 2025. 24 has been a great year so far. Couldn't be prouder of the team. We'll have the SoFi leadership group in here in San Francisco in the next 2 days. We do it twice a year, once in September, once in February. This meeting is going to focus on setting our 2025 priorities. I've been working on those for the last 6 weeks with the team, and we're going to share them with the team tomorrow. I get chills just saying it. We're just getting started. 25 is going to be a great year. The priorities we have as a company for next year really lean into the different areas that I mentioned, and I think it's a year in which we could really pull away from the rest of the pack. So we'll share those with the investment community when we report the fourth quarter in 2025 and give 25 outlook. But I love where we are, and finally looking at light at the end of the tunnel, being able to operate in an environment that could be really positive for us overall.
Overall, I thought this was one of the more exciting talks that management has participated in, not just because they talked about these secret products or lending as a service or stuff that we've never heard before, but also just hearing the metrics and the interesting observations of how data-driven that business is as an entirety, how they make decisions, how they have sophisticated underwriting models, how they leverage Relay, for example, in all of these decisions. And it's particularly interesting because when you think of SoFi being data-driven, generally analysts will think just on the underwriting models, that they're data-driven in terms of who they loan out to, what's the credit box that they loan out to, and what's that life of loan losses look like. But in fact, they're talking really a lot about data-driven decision-making in terms of leveraging Relay for how you should be spending that money, how you can optimize your expenses, how you can optimize your spend. They're leveraging data in the cross-selling of that flywheel ecosystem of what you would be a good candidate for in other product lines. And all of this is really helping them achieve some operating leverage to essentially churn more money out of their business. And ultimately, what that's going to lead to is it's going to lead to a higher revenue per member once they decide to turn that on and they optimize that model even further. And I mean, he touched on this. He said that for Invest, the playbook is very simple. It's going to be the same playbook that they leveraged for SoFi Money, and they're just at a different point in that life cycle for that product. But that's also not only going to be benefiting the entire ecosystem, but contributing to that 80% plus growth in financial services. Anyways, I hope you enjoyed this breakdown. Let me know what you think in the comments below. And thank you so much for watching.